Hello everyone, my name is Mark Jarvis and I'm a visiting professor at Manchester Metropolitan University in the Accounting, Finance and Banking Department. Welcome to this June issue of a monthly series of webinars which looks at issues in the UK economy as well as global issues. This month we'll talk for a change about the UK economy. Not that COVID has gone away, but some issues in the UK economy are becoming increasingly, pressingly visible. Of course, inflation being one of them. Before we move on to global taxation, property prices, and of course, that never going away hybrid working environment. Before finishing on a quick flyby look at the tourism sector and its, let's say, its plans for a recovery. So let's start with inflation. The Bank of England has said that prices are increasing faster than it expected, and inflation is likely to rise above 3% in the months ahead, but added that the problem is transitory and should not affect monetary policy. The UK Central Bank's message today, Thursday, the 24th of June, came after data had shown, and if I may just for a second with you share some latest graphics of what that looks like. Shown that inflation has been rising faster than it previously forecast, literally as the economy has rebounded more strongly than anticipated. The bank rate was, however, maintained at 0.1%. The Bank of England's Monetary Policy Committee, the MPC, it sets monetary policy to meet that 2% inflation target. And in a way, of course, this helps to sustain growth and employment. But at its meeting, the committee judged that the existing stance on the monetary policy remained appropriate. So again, and importantly, the MPC voted unanimously to maintain the bank rate at 0.1%. So, having voted unanimously, they also went on to vote unanimously to maintain the stock of sterling non-financial investment grade corporate bond purchases. This is financed by the issuance of central bank reserves, and this was maintained at a level of £20 billion. The committee also went on by a majority, this time of 8-1, for the Bank of England to continue with its existing programme of UK government bond purchases. This is financed by the issuance of central bank reserves, maintaining the target for the stock of these government bond purchases at that level of £875 billion. So the total target stock of asset purchases overall is £895 billion. In the MPC's central projection in the May monetary policy report, UK GDP was expected to recover strongly over 2021 to pre-COVID-19 levels. Spare capacity in the economy was, I think, expected to be eliminated as activity picked up. And there was expected to be a temporary period of excess demand before demand and supply returned broadly to balance. CPI inflation was projected to rise temporarily above the 2% target, owing mainly to developments in energy prices, I think. As these transitory effects have faded, conditioned on the market path for interest rates, inflation was expected to return to around 2% in the medium term. However, the bank staff have revised their expectations for the level of UK GDP in 2021 Q2 by around 1.5% since the May report. And I think it's worth looking at this more globally just for a second, where you can see that it's not only the UK that is seeing this GDP rebound. It is a global phenomenon of GDP rebounds. Certainly in the UK, GDP grew as restrictions on economic activity have eased, so that output in June is expected to be around 2.5% below its pre-COVID 2019 Q4 level. This recovery in activity has been most pronounced in, of course, the consumer-facing services, for which restrictions were loosened in April. Output in a number of sectors is now around pre-COVID levels, although, of course, it remains materially below in others, and we'll talk about that in a minute in the tourism sector. The housing market remains strong, and indicators of consumer confidence have increased. The direct economic implications of delays in the final stages of the relaxation of COVID restrictions are likely to be relatively small, I think, compared with the impact of previous stages. Unemployment fell slightly to 4.7% in the 3 months to April, although it's likely, I think, that the labour market slack has remained higher than implied by this measure. Again, the committee's expectation is that the direct impact of rises in commodity prices on CPI inflation will be transitory. More generally, the committee's central expectation is that the economy will experience a temporary period of strong GDP growth and above target CPI inflation, after which growth and inflation will fall back. There are two-sided risks around this central path, and it's possible that near-term upward pressure on prices could prove somewhat larger than expected. Taking together the evidence from financial market measures and surveys of households, businesses, and professional forecasters, the committee judged that the UK inflation expectations remained well anchored. And I think that's very important. Fueling these issues are confidence. In June, as businesses continued to rebound, according to a closely watched survey that showed commercial activity fell back only slightly after last month's reopening from lockdown. The IHS Markit CIPS Interim Composite Purchasing Managers Index was 61.7 in June, down only slightly from a record high of 62.9 in May, and matching some of the highest readings since the survey began in 1998. But while economists said that the fallback suggested the reopening boom may have passed its peak, intensifying inflationary pressures highlighted the danger of price rising rapidly as business expanded. The measure of input cost inflation, which has risen for 5 consecutive months now, as reported by the survey, matched a record last seen in 2008, while the rate of output price inflation reached a record high for the second month in a row. The PMI data, which was collected from June the 11th to 21st, is a weighted measure of responses from leaders in the services and manufacturing sectors. Any reading higher than 50 indicates a majority of respondents reported an increase in activity. So, some other views. Reese Herbert, a senior economist at Lloyds Bank, said that while the data pointed to a strong ongoing recovery, worker shortages, supply chain disruption, and rising cost pressures were starting to hold back output. For example, a global breakdown in supply of resin is hurting a wide and varied set of manufacturers in the plastic sectors, and this is just one product. Samuel Toombs, chief UK economist at consultancy Pantheon, said the upbeat PMI readings jarred with other evidence, on the other hand, such as the ONS business survey that pointed to a sharper deceleration. Market survey often is more of a sentiment barometer, I think, than a precise gauge of business activity, and perhaps month-to-month growth in gross domestic product probably slowed to around 1.5% in May and 0.5% in June. But a word of warning, I think. Andy Haldane, the Bank of England's outgoing chief economist, writing recently in the New Statesman, said that inflation outlook was its most dangerous for almost 30 years. Inflation in the UK had jumped from 0.4% in February to 2.1% in May, as we have said, a much faster rise in the Bank of England. The bank's February forecast showed the Monetary Policy Committee expected inflation to reach around 1.6%, and these forecasts were revised higher last month, 1.8%, ahead of the release of the official data last week, again at 2.1%. So, of course, it's not just the UK. The Consumer Price Index for all urban consumers, CPIU, a closely watched measure of inflation in the US, has continued its upward trend in May. And if I just share with you that view, you can see that with both the broad CPI for all items and the core CPI up significantly on a year-on-year basis. While the broader CPI was up 5% compared to a year ago, the core index, excluding more volatile food and energy prices, surged by 3.8% from May 2020 levels. So while the increase in the broad CPI was the highest since August 2008, the core CPI surged at the fastest pace since 1992 due to a combination of monetary and fiscal stimuli, as well as a drop on consumer prices in the spring of 2020. At the onset of the pandemic, prices had taken a dive due to falling consumer spending and a drop in fuel demand before climbing back to this pre-pandemic levels over the summer. But thanks to several rounds of stimulus checks, as well as interest rates that have been kept near zero since March 2020, prices have picked up notably in 2021, peaking in the latest reading. So while the Fed uses a different measure, the Personal Consumption Expenditures Price Index, which typically runs slightly below the CPI, to define and check its inflation target 2%, it looks increasingly likely that the Federal Open Market Committee could decide to hike rates for the first time since the onset of the pandemic at its soon meeting. While the FOMC announced that it would aim for inflation moderately above 2% for some time, to achieve a long-term average of 2% following its last meeting in April, the latest spike might be enough for the committee to take action. So I think let's keep an eye on this. It's been a while since we've talked about inflation, but here it is, and the spectre is there looming. I thought, given the recent G7, it'd be worth touching quickly on the global corporation tax levels. It's worth looking at this from a broad perspective from where people are around the world. I think if I can just share this myriad of different tax rates at the global corporate level around the world. G7 finance ministers are reaching a historic deal on corporation tax, which will see all 7 countries endorsing a minimum rate of 15%. The agreement comes after yet another case of a company paying zero tax that raised serious questions that involved an Irish subsidiary of Microsoft called Microsoft Round Island 1, making a whopping 315 billion profit last year, but paying no tax on it as it was resident in Bermuda for tax purposes. That sum is equal to nearly 3/4 of the Irish GDP, and it comes from a company that does not have employees. So such financial reports are becoming increasingly common. In May of this year, Amazon reported 44 billion euros in revenue for the previous year in Europe. But according to its corporate filings in Luxembourg, its unit there made a 1.2 billion euro loss. And therefore no corporate tax was paid. So I think such cases added urgency to the G7 negotiations. And the deal will see companies pay a minimum of 15% rate regardless of where their headquarters are located. It will also aim to close loopholes and force some of the largest multinational and tech giants, as Amazon, Microsoft, to pay taxes where they sell their goods and services, regardless of whether they are physically present in certain countries. The OECD estimates that the proposals could generate up to $80 billion worth of additional tax revenue a year, though the final figure will depend, of course, on the final points of the agreement. French Finance Minister Bruno Le Maire described the agreement as a starting point, and he pledged that in the coming months we will fight to ensure that the minimum corporate tax rate is as high as possible. There's still a lot of work to do, and support will need to be drummed up amongst the G20 nations, who will meet in Italy soon, while the wider negotiations will involve 139 countries. Nevertheless, the G7 events are a major step towards change, considering the implications for tax havens and multinationals alike. What will corporate tax rates look like in 2021? Okay, so if you've listened to some of these monthly webinars, you will know we've talked a lot about hybrid working and the future of work. And so from that point of view, I wanted to talk a little bit about some excellent work from McKinsey. Many captains of industry have made bold statements about the abhorrence of working from home. But maybe that was the old world and we have a new future. Anyway, whatever your views are, that old analogy of in the room or Zoom have gone, and a hybrid working environment is now here to stay. Interestingly, McKinsey's surveys of employees, and you can see some output here, which looks at the hopes and fears, shows a myriad of views. I think summarizing what I would see here is that employees see that the hopes for the future is a better work-life balance, better flexibility, increasing well-being, and these are all extremely positive attributes for your staff. Of course, there are many and varied strings pulling these hopes, but I think, you know, in these times, one has to listen to the employees, to the staff, to the resources, to see what their feeling is. It's very good making big, broad statements, but listening to what people are wanting and desire is very important. Though having seen the solid productivity gains amongst employees during the pandemic, many organizations are planning this hybrid virtual model that combines remote work with time in the office. McKinsey recently surveyed both employees and executives, and many of the employees surveyed feel they haven't heard enough about their employers' plans for that post-COVID working arrangements. Organizations may have announced a general intent to embrace hybrid virtual work, but I think the lack of transparency is leaving employees anxious. More than a quarter of employees surveyed said they would consider switching employers if their organization returned to fully on-site working. And we'll look at the slide on this in a second. But this is a big change for employers, I think. There's clearly room for improvement when it comes to transparency for employees. Most executives who envision a hybrid model say they have at best a high-level plan for how to carry it out. I think making the small moments count, companies that have articulated more specific policies and approaches have seen in employees' well-being and productivity rise. One notable finding from the survey is that organizations with the biggest productivity increases during the pandemic have supported and encouraged small moments of engagement between colleagues, opportunities to discuss projects, you know, sharing ideas, networking, mentoring, coaching. So, but I did say a little moment ago about that employees are concerned about the future, and that they are considering, you know, what would it take for them to leave, which is a very important thing for employers. A quarter of those surveyed reported that they would consider switching employers if their organization returned to fully on-site work. Of course, even employees who say they might depart could ultimately decide to remain, depending on the policies companies end up adopting, the availability of the jobs, etc., etc. But I think it's a very important dynamic to think about as corporates begin to review their working policies, and not just making a broad brush comment about everybody back in the office. So no time like the present. Mixing virtual and on-site work isn't going to be easy, given the risks associated with creating a two-tiered workforce among them. Yet the best leaders are using this time to re-energize their people and organizations. And many see, I think, a larger opportunity, the chance to build on pandemic-related accomplishments and really re-examine the organization's identity, how it works, how it grows. Of course, if you have a job, you need somewhere to live. And coming back to the UK for a second, a very interesting slide by Hamptons reflects on, one of the biggest life questions facing us, this generation, is whether you can or want to buy a home for yourself and the family. Something which has long been the norm in the UK is proving ever more unrealistic for young people in the country. And as a new analysis, as I said, from Hamptons shows, renting is now much more affordable option in a number of regions. I have to say, as covered by the BBC recently, those looking to settle down in London with a 10% deposit in their pocket would, despite the potential longer-term benefits of home ownership, be paying an average of £251 per month more than if they choose to rent. It's of course a different story in Scotland, where buying property would lead to monthly savings of £130. So a big difference between the different areas of the UK, and something we talked about on last month's webinar, which was levelling up, is something that is clearly very obvious here. Okay, one last topic, and finally, of course, something that we're all dreaming of is a holiday. Tourism experts, however, fear a long road to recovery. Coming off the worst year in tourism history, 2021 was off to a slow start, as well as travel remained subdued in the face of surging COVID infections. According to the United Nations World Tourism Organization, international tourist arrivals were down 83% in the first quarter of 2021 compared to the same period in 2020. Following an estimated 1.3 trillion loss in export revenue in 2020, travel restrictions largely remain in place, though the governments are desperately trying to curb the spread of the new, potentially more dangerous variants of coronavirus. This is hurting tourism industry clearly. While the brief rebound in the summer months of 2020 had fueled hopes of a quick recovery for the tourism sector, I think these hopes were quickly dashed by the fall winter wave of the pandemic. And sharing the last slide for today, this is the tourism's long road, I guess, to recovery, as it says here. 6 months into 2020, with vaccination campaigns well underway and case numbers receding in many countries, a sense of optimism is, of course, gradually returning as the tour industry has its eyes set on the upcoming summer season. But of course, that is very different in different countries. According to a recent UNWTO survey, travel experts remain cautious in their outlook, however, with the vast majority not expecting a return, as you can see from this slide, to pre-pandemic levels before 2023, and 49% saying 2024 or later. There is significant pent-up demand, of course, and I think we can see confidence returning. But vaccinations are a key point of the road to recovery. And I think it's important for governments to improve coordination and communication while making testing easier and more affordable in order to facilitate a travel rebound in the coming months. Among the experts surveyed, 16% a significant uptick in Q3 2021. 22% rebound will come in the fourth quarter, and 60% don't expect a meaningful recovery before 2022. So I would say as we all know, a long way to go on this subject. A lot of us holidaying in the UK, which is of course good for the UK GDP growth, but impacts on the tourism industry. But anyway, thank you for listening. That's it for this month, and look forward to speaking with you again in the next month. Thank you.